Welcome to Value Investor TV podcast. This is a podcast that helps you grow your wealth and become financially independent. This is episode 22, Valuation Ratio. My name is Becco and my partner, Hari. Welcome, everybody. Okay, in the last episode, we talked about the overview of valuation, operational, financial, ratio. There was an introduction of all those three ratios. In this episode, and then 2 episodes moving forward, we're going to talk about those ratios individually. And in this episode, like I mentioned in the title, we're going to talk about the valuation ratio. Okay, so just to quickly recap what valuation ratio is. Valuation ratio is always price to something. So effectively what it's trying to do is trying to say, okay, how much am I paying to get earnings or sales? We'll talk about different ratios, but it's effectively all about how cheap something is. This is what valuation ratio tells you. And there are many variations of it, many derivatives and flavors of valuation ratios that you can use to value different businesses or different aspects of a single business. And we have a few that we want to cover here in this episode. The first one is price to earnings. And we have price to book, price to cash flow, price to sales, PEG ratio, price to EBIT, and enterprise value divided by EBITDA. We'll talk about those subsequently. But first, let's focus on PE, price to earnings, because this is the most talked about in every investment journals or even newspapers. People talk about PE all the time. So Hari, define for us what price to earnings is first, and maybe dive into why they're so prevalently used, and maybe some of the downside of using PE exclusively.
Yeah. So price to earnings ratio is actually the current stock price. So is the numerator, and the denominator is the earnings per share for, and you can do it what's called trailing 12-month PE, which is the last annual PE or annual earnings per share. You can do a trailing 12 months, which is the last not annual report calendar year, but so if you're in quarter 2, you're using Q2, Q1, and Q4 and Q3 of to get that number. So you're just it's the last 12 months or the last 4 quarters added together. And you can do forward price to earnings ratio, which is we estimate this is what the earnings are going to be next year, and then we use that as a measure of a price to earnings ratio. And so what you see a lot of is companies will, or this ratio is unfortunately is overused a lot. I think in companies on CNBC and websites, financial websites will talk about price to earnings, and they will use forward price to earnings, especially for fast growing companies, as if it's a good measure of a valuation, because you're essentially saying, well, if next year it's going to grow to this, it's cheap enough to do that. So let's kind of break that down a little bit more and say why is this an important ratio? Well, what it is essentially telling you is how long does it take you to to earn back in earnings, the current share, price that you pay for the stock.
Yeah.
Right?
I just want to mention, because you mentioned it really briefly, what the definition of price to earnings is. Maybe define that more in detail, more robustly here. So go ahead.
Yeah. So the current share price, right, which is what you would get quoted from, Yahoo Finance or your broker or wherever. And then it's divided by the earnings per share, right? So the earnings per share is the net income divided by the shares outstanding, right? So the other way to do this, right, is actually you can take the entire market cap of the company, which is the price, times the number of shares outstanding, and divide that by the net income for the company, right? And so what you essentially did, if for you math whizzes out there, is we just actually played with where does the shares outstanding exist. Is it multiplied by the price, or is it divided by the net income? So either way, you're going to get the same ratio. And and this is actually true, will apply for almost everything that we talk about here, right? Is that all of these are per share valuations, right? So price per share of something, book share, book a value per share, cash flow per share, sales per share, etc.
Well, in these ratios, the per share cancels out.
Yes.
From denominator and numerator. So effectively, it's for us humans to be able to say, okay, per share is this. It makes it a lot easier for us to consume that information. But effectively, these ratios, they don't really, it doesn't matter if you're using per ratio, a per share value, or just the entirety of the market cap divided by the entire earnings.
Yeah, it's probably a good idea to think of when we say price, it's actually price per share and earnings per share. Yeah. And so when you look at it that way, the per share, as he was saying, drops off. And so if you could also look at it as, if I went to somebody who owns a business and I just said, how much do you want for that business? I'm not offering on a per share basis. Well, the per share there is actually, there's only one share, and that the business owner is offering me a price, right? And so it's just depends on the denominator of the per share component, right? Yeah. So let's kind of put this into context, right? Because I think this is very important. The price to earnings. If I were buying a company with price to earnings, and I went to a private business owner, right? Private business transactions are occurring at a price to earnings ratio of 6 to 9. The number is, and that's not a hard and fast rule, certainly, but that's the expectation, is that if I bought a company, the earnings from that company would be able to pay for what the price I paid in the next 6 to 8 to 9 years. And that number, the PE ratio, is basically the time to for earnings to cover the price of that I've paid for it. And so what you want to look at is, with businesses like this, is there should be some grounding in reality, right? At the height of tech bubbles and stuff like that, what you see is there are a lot of companies that are trading for like 75 times earnings and 150 times earnings. And the reason they get those rich valuations is that they are supposedly going to take over the world, right? And they're going to be able to, be multi-billion-dollar companies and and so you're paying for future earnings, right? Because ultimately, as we've always said, the reason companies exist is to make a profit for their owners. The shareholders are the owners of the business, and so if the price is that you're paying is 6 to 8 times for a company, then but if another business is trading at 12 times earnings or 15 times earnings or 20 times earnings, all else being equal, you would want to pay for the business at a 6 times rate rather than a 20 times rate. And when you start getting, beyond those numbers of 6 to, 20, what you want, what happens is there may be a point where the business could never recover that amount of, could never create that much value for its shareholders in terms of earnings. And so, there is too expensive a price for every single business out there, right? I mean, you can make the argument that Apple is a great business, but it's currently trading at $1 trillion, right? So knowing nothing else, at $15 trillion is too expensive for Apple. I mean, it doesn't matter how much earnings they make over the rest of their life, right? That's just too much money, right? And also what happens is, as you look at future earnings, those earnings are so far in the future that they're basically worth nothing to you today, right? And we'll talk about that when we start actually doing a valuation exercise on free cash flow. So really, the earnings that you should be focused on are the next 5 to 8 years, because that's all that you can actually get out of a business, right? Anything beyond that, anything can happen. We could go to war, something could, change. The company could, become bankrupt. So it's really the next 5 to 10 years that you can really focus on as a corporation, because that's all that's predictable. Now, you would hope that through your process, beyond 10 years is also something that this company will exist, right? So coming back to this ratio, right? The price to earnings really is what it's telling you is, relative to how much earnings they have, what price am I willing to pay, right? And the danger with that, because there's a lot of caveats to using this ratio, is a couple of years, companies may have depressed earnings for a variety of reasons. They may be investing heavily in growth, and they are expecting in future years that growth to skyrocket, and then that earnings per share will go higher. So how do you estimate that, in context of what is the current EPS, right? The other thing is earnings per share is not a number that can be manipulated, right? And legally. So, I mean, we're not talking about illegal manipulation. There's also that. But the earnings per share, as we talked about, is not cash into the business, right? It is it is using accrual-based accounting. So they're shipping revenue, they're shipping items, but they haven't actually collected the cash on their goods. And so that affects how much money that they're, is actually seeing. And so earnings are not what we care about as business owners. What we care about is free cash that comes in. And so using earnings per share can sometimes give you spurious, variables. And so I would encourage you not to just, it's a good rule of thumb, but it is not a be-all, end-all answer for that. Now, that being said, if you were to buy a portfolio, I mean, historically, from the 1960s till 2016, when I last saw this number updated, if you were to buy a low PE, ratio relative to the rest of the market, your returns would, beat the market over that period of time by some insane amount of money. So that's not to say that this is a bad way of looking at valuation, but there are other things to look at when you look at this.
Mm-hmm. And you mentioned, it's a private business usually is selling for 6 to 9 times PE, and that effectively means you're going to get your money back. You're paying for 6 to 9 years worth of growth in the future if the earnings were to stay steady.
Yeah.
Right. And so another key point that I want to mention here is the earnings here, and every metric we're going to talk about here in this episode is price to something, and price to earnings in this case is 12 months earnings or a year's worth of earnings.
Yeah.
So take that into account, because that was what confused me in the beginning. Okay, 6 to 9 times PE, and that's saying 6 to 9 times you're paying for forward 6 to 9 years. That means earnings has to be that for 1 year or
right.
Trailing 12 months or moving
Correct.
forward 12 months.
Yes,
it's always on a yearly basis. Okay, so Hari mentioned a lot of things there. PE, good rule of thumb, but not the exclusive valuation metrics that you should focus on. There are other metrics that you should also look at.
Yep.
And so why don't we look at those? PEG is another one that kind of relates to this. Do you want to talk about that? So PEG ratio, PE divided by EPS growth rate.
Yeah. So when you look at the this was a metric that was really popularized by Peter Lynch, and I don't think he invented it, but he certainly used it heavily in his business dealing. And what he was kind of looking at was, you have the price to earnings ratio. Let's say that it is 10, and you have a company that is growing at 5% a year, right? So that has a PEG ratio of 2, right? So the percentage growth is the denominator, and the price to earnings ratio is the numerator. So 10 over 5 is 2. So if you look at a business that is trading above 1, what he's essentially saying is that company is expensive relative to their growth rate. And if you look at a company that is trading below 1, that is I think he even was more conservative in his measurement, was between 0.5 and 1 was, roughly fairly valued as a business goes, and less than 0.5 was cheap, right? So if you could find a business that was growing at 30% a year and was trading at a PE of 15, well, then you had a bargain on your hands.
Yeah. I want to mention one thing. When you say growth, what we're talking about here is EPS growth, not
Correct.
Sales growth, not operating growth.
Correct.
This is earnings growth, the very bottom line we talked about in the earnings income statement episode.
Yeah.
what Hari's talking about here is EPS, the earnings growth here.
Right, and that's on a year-over-year basis. The growth rate for that earnings is measured by taking this year's earnings, subtracting last year's earnings, and dividing by last year's earnings, and that'll tell you the growth rate, right? And so that number is a percentage, right? And that number can be, so if you have $100 this year and $115 next year, that translates into a 15% growth rate. So that number, that 15% growth rate, you want to, using Peter Lynch's measurements, you want to have a PE of like 7.5.
Yeah.
Right, because that'll tell you that it's at trading at 0.5.
Yeah.
Right, and so that, what has changed over the last 10 years is that when interest rates go down, PEs in the stock market go up, and that's because people move their money out of bonds and other fixed income assets and move them into stocks, because stocks become relatively more valuable. And so what you see is now we have PEs in the 20 to 25 range, which is historically high relative to what it's been in the past. And in recessions, like in 2008, the PE ratio was 8.
Yeah, single digit. That's crazy.
For some companies. And so, and even today you'll find companies with PEs of 8. So it's not every business.
Yeah.
But what that means is that when everything is on sale, then you have the opportunity to buy some fantastic businesses at a very cheap price, right? Mm-hmm. And that's a good thing for you to do.
Yeah. So go ahead.
Just one last thing about the PE ratio is that, because earnings can be kind of manipulated, what a lot of people did, and this is something that Ben Graham kind of talked about, was using an average of earnings over a period of time, maybe 3 years, and then looking at that instead, to compare a growth rate, rather than, so look at it 10 years ago and look at it now and see what that number is, and taking an average of those numbers. Because businesses are going to have fluctuations all the time, and you want to kind of smooth those things out. So, for example, there's a lot of companies that have one-time charges, one-time expenses, and when you look at that EPS number, it may have have to be adjusted up or down to kind of reflect that. Yeah. And so that's not part of the operating business. You shouldn't use that as part of this PE ratio.
Mm-hmm. Okay, so that is PEG ratio, PE divided by EPS growth rate. So that's a percentage. Drop the percentage and use just the absolute number there for the denominator. Okay, so let's move on to the next valuation ratio, which is price to book. Price to book. Tell us what it is and why it's useful, Hari.
Yeah, so this is, going back to our thing, this is price per share divided by book value per share. The other way to do this is the market cap over the equity, right, of the company, shareholders' equity. So typically what you're looking for in here is companies with a lot of assets. Remember, book value is assets minus liabilities, right, which is also the same thing as equity. Companies with a lot of assets and liabilities will have, or assets, they're asset-heavy businesses. This could be a good metric to look at. The other place that this is important is like financial companies. So businesses like banks, insurance companies, where they don't have a real, they have their product is a service, a financial service. You would want to look at this, and in those cases, a bank typically has a price to book. If it is below 1, is essentially you're buying $1 for 80 cents or 75 cents, and obviously you want that margin of safety when you buy this. So, I don't usually use price to book because I don't typically invest in financial companies, but if I do, price to book is one of the metrics that we look at.
Also like holdings company, for example.
Yeah.
So Fairfax NDO or Fairfax Financial.
Berkshire Hathaway.
Berkshire Hathaway is a great example.
Yeah. So that's, so it really depends on what kind of business you're looking at, where you would use that metric. But in a lot of ways, those holding companies are financial companies, right? And because they have assets, and those assets generate some amount of money. How much money is that generating for the the company relative to their thing? So.
Okay, so that was price to book.
Yep.
Let's move on to price to free cash flow. Okay, actually, before we do that, a lot of times people will mention earnings multiple or sales multiple or free cash multiple. That's effectively the same thing as what we're talking about here.
Correct.
So when people say, oh, earnings multiple of 10 or earnings multiple, it's trading at earnings multiple of 20. That is the same thing as PE equals 20.
Yes. They may say it as trading at 20 times earnings or trading at a multiple, what is their typical multiple that they're trading at? So people in general like to use rules of thumb for these kind of things, and they're pretty lazy and don't actually do the work to see that. And so you hear it all the time in the venture capital world. You hear it all the time in the finance world, in investing. So don't stick to hard and fast. Stay away from these rules of thumb.
Yeah.
Okay.
Yeah. So I just wanted to clarify that. So people might hear the multiple. That's effectively the same thing as what we're talking about here today. Okay, let's move on to the next metric, which is price to free cash flow.
Yeah.
Tell us about that, Hari, please.
Right. So this is probably a better metric than price to earnings. Because if we look at it from our perspective, right, as value investors, what we care about is not the earnings, right, not the accounting earnings. We care about the cash, right, that's in the cash register at the end of the year. And so price to free cash flow is kind of telling us, so just for those who don't remember what free cash flow is, and we will do an entire episode just dedicated to this calculation and how it translates into valuation. But you essentially take the net income, you adjust for accounts payable, accounts receivable, and so on.
The non-cash expenses.
Non-cash expenses, depreciation, amortization. And you are left with the cash flow from operations. You take that number and you subtract the expenditures for investments in property, plant, and equipment, and you get a free cash flow number.
Yep.
And it's also, this number is not, it's good to use a cash flow, capital expenditures or price per property, plant, and equipment investment, over a multi-year period, because, companies will have fluctuating amounts of investment.
Yep.
And you use that number to then determine what's called free cash flow, which is, if I just want to maintain this business, how much money is it going to cost me, right?
Mm-hmm.
And that's what the free cash flow number tells you.
Yep.
Right? So now that you're looking at that number, price to free cash flow, it follows the same kind of guidelines that we talked about with price to earnings, right? Typically, as a business owner, I want to see 6 to 8 times earnings, right? If I'm going to make an offer for a business, that is a relatively reasonable amount of money, because I'll get paid back 6 to 8 years from now, right? Now, obviously, this doesn't take into account any debt that the company has, right? And the price doesn't reflect any debt that the company has. So if I am generating 6 to 8 times cash, right, what I don't know is how much debt do I have to pay off, with that, just looking at that metric in isolation.
Yep.
And the same is true for price to earnings, right? Because a company that has no debt versus a company that has a lot of debt, that number is really different, right? And so how much money am I taking home and taking out of the business will really depend on those factors. So again, these are all just kind of like a good way to start, but it's not a great place to make it, purely make a decision on this,
yep.
right? And so typically when the lower the number, obviously the cheaper the business is. But this is also, again, like with the earnings per share, you need to make sure that this cash flow that they had for this year, their PE or price to free cash flow is 6. Oh, that's a huge bargain. But next year it's gonna completely fall off, because they're shutting down certain business lines, or they sold off something that generated a lot of cash for them. That's not a sustainable business, right? And so you have to take into account all of these other parameters, like, is this a sustainable amount of cash flow?
Mm-hmm.
And, ultimately, is this going to grow, because the business is going to continue to invest in future growth rate, in the business. So,
right. Okay, so that's free price to free cash flow.
Yep.
The next metric, I don't think this one is as useful. I've never personally used this as much. Price to sales.
Yeah.
So tell us about that, Hari.
So again, this is also price per share divided by sales per share or revenue per share.
Which is the top line.
Top line
in the income statement.
Correct. So when you look at those two numbers, what you're really trying to do is... So I haven't really found a great use case for this. Some people, what they do is, because revenue is not easily manipulated by... they use it as an industry comparison, right? And so that's kind of where I see it as the best use of this. But it really kind of tells you, like, relative, like, to their, the price, they use, sales. Now, remember that every time that you are looking at an investment, there's usually somebody who's trying to sell you something, right? And that may be the CEO of the company if they're focusing on price to sales, or they're focusing on revenue growth, you should be very careful about that, right? Because what they're telling you is revenue is not profit, right? Profit is what I keep. Revenue is how much I sell, and then I have to, essentially take money out of the business at the end of the day. So if companies are really focusing on price to sales, or if somebody's trying to pitch you something based on price to sales, what you should be asking yourself is this going to actually translate into money at the bottom line? And if the answer is no, a lot of companies what they do is they tout this number because they're not profitable, and they use price to sales as a way to say, hey, I'm cheap because, but that metric cannot hold up if there is no price to earnings.
If the earnings is negative, yeah.
Yeah, if the earnings is negative, then who cares?
Yeah, who cares about the top line?
And I'll tell you where I see this more often than not, and it drives me nuts, is in the venture capital world. That's all they focus on is revenue multiples.
Yeah, revenue multiple, or, active monthly user.
Yeah, those kind of metrics.
Yeah. Okay. So that's price to sales. Maybe not as useful in valuation exercise, but perhaps good for industry comparison, peer group comparison.
Yeah.
Okay. Moving on to the next one. Price to EBIT. Remember, EBIT we talked about in the income statement. Maybe Har could do a refresher on EBIT and then talk about price to EBIT.
Yeah. So EBIT is just a little further down the income statement, but it's not quite at the net income level or the bottom line, right? So EBIT is the operating income, right? And so that is another term so EBIT stands for earnings before interest and taxes. So interest and taxes is what's subtracted out after operating income to get to net income. Yeah. So if we start at the top, what we have is revenue. We subtract the cost of goods sold, which then gives us our gross profit. And then from gross profit, we start subtracting again the selling, general, and administrative expenses, research and development, and what we're left with is EBIT, or operating profit. And so the reason that number is important is EBIT is a very good measure of industry to industry, or I'm sorry, company to company within an industry, because it tells you the two things outside of their financing structure of the business. Because let's say I come in and I want to buy a business, right? If two businesses are operating at the same, with different financial structures, but are in the same industry, now I can compare those two businesses, right? Because, debt is something that you can pay off over time or whatever, but you want to see how the fundamental business itself is operating. That this is a good way to measure it. Yep. And so you can use this to compare how profitable, a company gets to, relative to each other. That's how you would, with the operating margins, which we'll talk about in the next episode.
Right. It's because it's before interest and tax.
Right.
So again, to Hari's point, before interest. Interest is what Hari's talking about here. If you have a lot of debt, your capital mix has a lot of debt in it, then you got to pay a lot of interest, and that's why it's hard to compare the net to net.
Yeah.
If you're just trying to compare the operating efficiency of company A to company B in the same industry.
Right.
Okay. So just going back to the ratio price to EBIT, tell us, tell us about that. Now that we've defined EBIT.
So this is not a commonly used metric, and it's not necessarily because it's a bad metric. It's just not something that people talk about. But I hear a lot of people saying that they use the corollary, which is EBIT EBITDA, earnings before interest, taxes, depreciation, and amortization. So if you ever start hearing yourself saying that term, EBITDA, just slap yourself right then, because it'll solve all of your problems. Because it is
slap yourself right then.
Yeah, it is a bad idea. Okay, because for a lot of reasons, right? One of it. So this was a term that was popularized a long time ago, in the 80s and 90s by private equity firms, because what they were saying is that depreciation and amortization are not cash expenses, right? And so we want to eliminate them, and we want to use that as a cash flow, to look at it from the cash flow perspective. But the problem with that is you don't take into account the maintenance capital expenditure expense, right? Which is the property, plant, and equipment, which is how you get to cash flow, right? So what they were trying to do is they were trying to be lazy about getting to a cash flow number. And so they started using this EBITDA number. Now, in a tech business, it may be the same, right? But just if you ever find yourself talking about EBITDA, right, slap yourself, right? Because it's a stupid number.
Yeah.
Because it's very misleading, and it's very easy to create this, false narrative about a business, right?
So EBITDA, let me just clarify this for our listeners. EBIT, EBIT, is what we called EBIT in the previous valuation ratio. We talked about price to EBIT. In this one, what Hari's talking about is EBITDA. So EBIT, earnings before interest, tax, EBITDA, DA, depreciation and amortization.
Correct.
So effectively, you're adding in depreciations and earnings into the income, or
Right.
actually not taking it out from the top. Either way, same thing. EBITDA is what Hari's talking about there.
Right. And so just to clarify that, because we were actually talking about EBIT, and I jumped the gun here a little bit. EBIT is an appropriate term, for a measurement, price to EBIT, or price per share versus EBIT per share. But and it's a good measurement across business lines, right? Across two companies without their financial structure, because companies operate in two tax jurisdictions. One may have a higher tax rate, one may have a lower tax rate. So EBIT can kind of help you measure those two things. And then, of course, one of the things, if I own the business and I'm in a very high tax jurisdiction, I can also move to a lower tax jurisdiction and save me some money, right? So, that's one way to look at it. The other thing is that, people measure, the enterprise value, right? And so we haven't talked about that yet, but this is an important metric because it actually takes into account the debt also, right? So enterprise value is the market cap, which is
the price here.
It's essentially the price, but then it also includes all of the debt that the company would have to pay off, right? And so if I were buying a company, I'm essentially buying their debt also. I'm not paying for it right up front, but I will have to pay for it eventually, right? So it's not a perfect metric, but it can tell you that, if a company is unleveraged, like they have no debt, versus a company that has a lot of debt, that helps you get an understanding of what is that relative to the total amount that you would have to pay, which is why people use that enterprise value calculation. And what I see is they use enterprise value to EBIT. And that's actually another metric that you can look at to use to tell you, because the EBIT number will tell you how much you're having to pay relative, how much money can you generate relative to the total amount of money you're paying for the business, right?
To arrive at the enterprise value, like we talked about for price, price is effectively market share or market capitalization divided by number of shares outstanding. Enterprise value is effectively the same thing, market cap plus debt, or you can do price per share plus debt per share. Same thing. Just for you guys who are having a hard time trying to wrap this thing or wrap this concept around your head. Okay, so we covered all of those ratios we wanted to talk about in this episode, starting from PE, price to book, price to free cash flow, price to sales, PEG ratio, so which is PE divided by EPS growth rate, price to EBIT, and we also talked about the enterprise value divided by EBIT. And as a bonus note here, Hari threw in his opinion about the EBITDA.
Fact. It's not an opinion. It's a fact.
So that is all we wanted to cover in this episode.
Yeah. Well, also in summary, EBITDA means you should hit yourself. So don't
slap yourself in the head.
Well, so before we go, I will. I was talking to one of my daughter's parents. Her friend's parent at a party, and he runs exercise companies. Like he has a like a
gym or something.
Yeah, it's like a gym, like Gold's or something like that.
Okay.
He's running these this thing, and he was telling me about his business relative, and using the EBITDA metric. And the reason that he was using that was because the business was unprofitable, right? And because what you do is when you have a gym like that, you just spend all of your profit is spent on replacing equipment. Every year you have to spend a ton of money maintaining the equipment that you already have and replacing it, because turns out people drop stuff, they break things, treadmills wear out, you have to replace them. And so all of his money was just being respent on that. But he was using the EBITDA number because that's what the private equity firms were looking at. And it turns out that who cares how much money? I don't care how much revenue you have or how much. At the end of the day, your entire business doesn't make any money, right? And you can tell me EBITDA all day long, but I'm going to be like that. Your business is still worthless, right? In terms of you're essentially just funneling all of your cash into. Now the guy who sells the equipment or runs the maintenance company, he's probably making a lot of money. So,
and I think to lend more credence to your fact or opinion,
fact.
I just want to say Charlie Munger is echoing your sentiment.
Yeah.
So Charlie Munger effectively said the same thing. If you find any companies using EBITDA as their valuation metrics, stay away. I don't know exact quote from Charlie Munger, but Charlie Munger effectively said the same thing.
Yeah, I think it's very important to remember that it is not. It is a disingenuous number because it is trying to intentionally mislead you, right? The only reason people would use that number is because they don't want you to know that their maintenance expenses are real, right? And that's, just because you're paying for something that's going to last multiple years doesn't mean it's not it's a fake expense, right? Depreciation is a real expense. It is just how we account for it is not reflected well in the income statement, right? Yeah. And so the actual cash outlay is real. And so trying to get to free cash flow, just use free cash flow. Don't use EBITDA. Just use free cash flow. That'll tell you more than you need to know.
Yeah.
Right?
So, I see a lot of EBITDA actually in REIT. So Hari and I were looking at this company that is in real estate investment trust, and a lot of real estate companies will report EBITDA. And if I were in their management trying to present ourselves, trying to present our company, EBITDA would, paint a rosier picture, obviously.
Correct. Yeah, and that's why they use it. Yeah. Right.
Okay, so that is the end of this episode 22, valuation ratio, starting from PE all the way to EBITDA. We talked about all of those metrics that could be useful for your investment exercise. Okay, in the next episode, we'll talk about the operational ratio. And thank you guys for joining us in this episode 22, valuation ratio. If you liked the episode, please do subscribe and leave us a comment or send us email at info@valueinvestor.org, O-R-G. And then follow us on Facebook and Twitter and Instagram. We do have an Instagram account. Okay, awesome. Thank you guys. See you on the next episode.
Thanks.